What's up team, it's Andy Wang from Clarico, and in this Structures Explained video, we'll be explaining the trust structure. There are a few different types of trusts. The two main ones are the unit trust and the discretionary trust. In this video, we'll be talking about the discretionary trust. Now, before I go into it though, I do want to cover off on another common term called the family trust. The family trust is just a type of discretionary trust. It's probably the most common type. You don't come across many discretionary trusts which are not family trusts. So, for the purposes of this video and for simplicity's sake, everything we talk about in this video about discretionary trusts can apply to a family trust too. I'll be breaking down this video into a few different sections. Number one, what is a discretionary trust? Number two, the benefits of this type of trust structure. Number three, the disadvantages, and finally, who should consider using this type of trust. Before we get into it though, disclaimer time, the information we cover in this video is just to help you understand the trust structure better. If you're a lawyer or a fellow accountant watching this, I apologize in advance. I'm not going to be using any technical lingo or legal jargon, and sometimes it might sound like I'm oversimplifying things. This video is just to help you and people understand the trust structure better. We'll be covering the main talking points of a trust, and like there is with anything, there are nuances and exceptions to things that we talk about in this video. So I highly recommend, before doing anything, check in with an accountant before locking in things like structuring your business or structuring your investments. All right, with that out of the way, let's dive in. First things first, what is a discretionary trust? Out of all the different structures, the discretionary trust is probably the most complex. It's so complex that even many professionals still don't get it. Unlike a company, a trust is not a separate legal entity, meaning it's not a separate person in its own right. So, what is it then? Rather than being a separate legal entity, a discretionary trust is a legal arrangement between a few different parties. This arrangement pretty much says one of these parties needs to look after things of value for the benefit of the other parties. Which means for a trust to exist, you need a party which manages and looks after valuable things, a party to benefit from these valuable things, and something of value to kickstart this whole arrangement. I mean, it could be anything as long as it's got some tangible value to it. It could be like a $100 bill. You can always add things of value later to the arrangement. You just need something of value to kickstart it at the beginning. If you're missing any of these aspects, then you can't really have a trust because the arrangement isn't complete. It'd be kind of like having a noodle soup without the noodles. Not very nice. To help illustrate the point, let's run through an example. To illustrate the ingredients you need in a trust, not a noodle soup, let's pretend we are in a rural village with a bunch of villagers. In the middle of the village, we have a well. This well is super valuable to the villagers. They all get their clean drinking water from this well. To prevent any one villager from taking all of the water for themselves, the villagers appoint Kath and Kim to look after the well and manage the distribution of water from this well fairly. In this situation, we have all of the aspects to create a trust if we wanted to. We have the party who looks after valuable things, that's Kath and Kim. We have the party who benefits from the valuable things, the villagers, and we have the valuable thing, the well. Now, hopefully you have a better understanding of what a discretionary trust is and how it works. Let's run through the few different parties we need in a trust. The first one we'll start with is the settlor. Once you have all of the different aspects of a trust ready to go, the settlor is the party which essentially makes a trust official. That's all they do, and they generally won't do anything else. They have nothing to do with the day-to-day of the trust. They won't make any decisions for the trust, they don't benefit from the valuable things in the trust, and they just make the trust official. That's it. It's kind of like if you have like a grand opening for something and the local politician rolls in and cuts the ribbon and disappears. It's kind of like that. Super commonly, the settler is just your accountant or lawyer who helps you set up the trust. The second role is the trustee, and you can have more than one. The trustee or trustees are the parties who manage and look after the valuable things in the trust. This is the party who is responsible, and if anything goes wrong, it's kind of on them. Next, we've got the beneficial party, which are called the beneficiaries. I think the name gives it away. This is the party which benefits from the valuable things in the trust. They don't need to do anything else other than just rock up and receive whatever benefits the trustees decide to give them. And finally, we have a role called the appointer. And this party, all they do is they have the power to change who the trustees are, just in case they don't like how the trust is being managed. Let's jump back to the example and tie all of these different roles together in the context of that earlier example. Back to our village example, remember, we have the party who looks after the valuable things, the trustees. We have the party who benefits from the valuable things, the beneficiaries. Let's add a few more parties. Imagine we have old mate who cut the ribbon for the grand opening. Here's the ribbon, and old mate just came, cut the ribbon and went. This is the settler. As previously mentioned, this person is just your accountant or lawyer or whoever helps you set up the trust, and off they go, not part of the village. And finally, the villagers decide they want some people involved to oversee the trustees, Kath and Kim, just in case they get corrupted and don't give water fairly. These people are called the appointers. With all of that out of the way, let's go into the main benefits of a discretionary trust. Benefit number one is tax minimization. Before I go into the how a discretionary trust saves you tax, let's look at how it actually works first. Remember, a trust is not a separate legal entity, it's just an arrangement between a few parties. Meaning, a trust, which is an arrangement, can't actually pay tax because it's just an arrangement. Instead, any profits the trust earns has to be taxed in the parties which receive the benefit. Remember, they are the beneficiaries. The tax rates that apply will depend on the tax rates of the beneficiaries, and that's where the benefit of a trust comes. The benefit is in the name. How much profit each beneficiary receives, which means how much profit each beneficiary will need to pay tax on, is completely at the discretion of the party who manages the trust, the trustees. So since the trustees can decide who receives the profits and how much each of them receive, this means that they can pick the beneficiaries who have lower tax rates to pay the profits to. And this is how trusts can be one of the most tax-effective structures of all time. The next benefit of a trust is asset protection. If a trust runs into legal trouble, it doesn't actually have to spell trouble for the beneficiaries or the trustees of the trust. On the flip side though, if you have valuables in a trust and you got into legal trouble personally and you're involved in this trust, those valuable things inside of the trust may not be at risk because those valuable things aren't owned by you. Instead, they're held in the trust for the benefit of the beneficiaries, not just you, for all the beneficiaries. So let's circle back to the example to see how these benefits play out in the context of our earlier example. Benefit number one is tax minimization. The trustee gets to decide who to give water to and how much. In this case, the trustees have full discretion. Let's say that the beneficiaries in this example get taxed on how much water they have. The more water a trustee has, the more they get taxed, and the less water they have, the less they get taxed. The trustee can then just give water to the beneficiaries who have less water. So in this example, we've got 3 beneficiaries who have more water, they get taxed more. The trustee will then just give water to the 2 beneficiaries with less water. They will then pay less tax on the water they receive from the well. Benefit number 2 is asset protection. In this situation, the valuable thing, the water well, is held in the trust. The question is, who owns the well? It's pretty hard to pinpoint who owns a well. Let's say, for example, villager Elon here gets into some legal trouble. Things that villager Elon owns will be at risk. But the question is, does villager Elon own the well? He certainly benefits from the water in the well, but he doesn't own it. And if he doesn't own it, then the well may not be at risk. That's an example of asset protection inside of a trust. A trust is packed full of benefits, but it's not without its drawbacks. Next, we will run through the disadvantages of a trust. Disadvantage number 1 is complexity. As with everything, you've probably noticed, there's a fair bit of info in this video, and that's just to understand the trust. If you go ahead with the trust structure, there's more admin, there's more accounting requirements involved, and there's just more stuff that needs to be done and boxes that need to be checked off. Granted, look, your accountant would handle all of this for you, but I still think it's important for you to understand it, or have a good understanding of it. Disadvantage number 2 is cost. Like with everything, when complexity goes up, there's more stuff to take care of, and that normally translates to a higher cost too. With a trust, you have the initial setup cost, and then because of all the extra admin and regulations involved, the accounting will cost more too for a trust. Disadvantage number 3 is tax. And I know. At the start I said tax minimization was a strength of the trust. It is, but remember, a trust doesn't pay tax in its own right, which means all the profit a trust makes needs to be taxed somewhere, even if you choose to leave the money in the trust bank account. It's great if you've got beneficiaries with really low income tax rates to pay to, but if all of your beneficiaries are on high income, they might be paying a bit of tax. And the final disadvantage for a trust is ownership. Remember, earlier when we said if you get into legal trouble personally, the valuable things in your trust may not be at risk because they aren't owned by you. This is also a double-edged sword. Mainly because with a trust, you've got full control through being the trustee and being the appointer. That's the party who manages the valuable stuff and the party who can change who the trustees are. But there's no ownership. There's no one is given a token of ownership which represents how much of the valuable things that you own. All the beneficiaries get is the opportunity to be considered for the handout of valuable things. It's not promised. Beneficiaries could get 0 if the trustee decides they shouldn't get anything. There's no own token of ownership, which means this will suck if you want to have an investor involved or want to reward a team member with ownership. Not the right structure for that. Let's go back to the example one last time to illustrate these last points. Disadvantage number 1 is complexity. As you can see on the screen, there's a fair bit happening. We have the appointers, the trustees, the settler, the beneficiary, the well. Having all these arrangements means there's more paperwork between all of the parties. The trustees, Kath and Kim, need to keep records of who is getting what and make sure they are following the rules of the village. Disadvantage number 2 is cost. How do we know that everyone is following the rules of the village? Well, that's where you bring in your accountants. We got the accountant here with the smiley face and the lawyer, not so happy, to set up everything and record it all. This is all going to come at a cost to the villagers. Disadvantage number 3 is tax minimization. Remember earlier we said that in this example, villagers got taxed on how much water they have? Imagine if all of the villagers already had bucket loads of water. The water in this well needs to go somewhere and taxed in someone's hands. So if it goes to the villagers who already have bucket loads of water, they're going to be paying more tax. Their tax rates are already high, and when they receive the water from the well, they're going to be paying more tax on that water. And disadvantage number 4 is ownership. Let's pretend old mate Elon from earlier. He's got a bright idea and thinks he can turn water in the well to wine. and he needs an investor. This is where the problem starts. Whoever invests in this well can't get any token of ownership which confirms how much of the well they own. We already can't establish which one of the villagers own the well, so an outside investor isn't going to have much luck either. So as an investor, they may be hesitant to invest because they can't have a token of ownership. With all that info out of the way, who should consider using a discretionary trust then? You may want to consider a trust if you're a business owner who you just want a small family-run business and you've got no interest in getting external parties involved or having other people in ownership of it. Another good use for a discretionary trust, instead of having a business in it, many people use it as a long-term wealth building tool. Because of the asset protection benefits and the tax benefits, many people use it as a protected treasure chest almost, where they hold investments like shares, crypto, property for current and future generations. Now, if that all sounds like a bit too much, or that doesn't sound like you, check out our other videos in the Structured Explain series to see what other structures may be worth considering for you. And as always, if there's anything you'd like us to cover, please pop a comment in the comment section below. And if you found this video helpful, we would love it if you enthusiastically clicked on the like button. And until next time, peace.